Hi, my name is Irina, and I'm a practicing accountant in Chicago, Illinois. Many of us get into debates in the face of today's economy, and no matter how nuts these debates get, somehow these discussions have become a form of science. Maybe you've wondered why all the tax cuts are targeted at wealthy investors. Are they really necessary, especially given the amount of borrowed money, only to be reminded that these tax cuts will stimulate both the investment and the growth in our economy? Don't you get it? The story goes, we can't afford not to cut taxes. Or does that only hold true for certain kind of investors? I engage in useful, open-ended, rant-free dialogue with everyday investors and people about their accounting questions. I've been having entirely too much fun talking about progressive tax, accounting, and the economy. Think of this podcast as a chance to hang out with someone who likes to tackle accounting questions and promises to answer them in an engaging and simple way. So let's get to it. Come on, what do you say? I'm just getting started. Welcome to episode 6 of the Tax Lady podcast. In this episode, we're going to explore the progressive tax system that the U.S. uses and what it means for an income taxpayer. Let's first discuss what is income tax. Income tax is a tax on money made from jobs or other sources like investments. It is the single largest revenue source for the United States government. Income tax has been the foundation of the U.S. tax code, and it is used to pay for public goods like roads, schools, libraries, and first responders. While tax rates are always changing, the U.S. tax code has been progressive since the 1860s. Here's what that means for you. Under a progressive tax code, people who make more money are taxed at higher rate than those who make less money. For example, if people who make $10,000 per year have to pay 10% of their income in taxes, while those who make $50,000 per year have to pay 20%, and those who make $100,000 per year have to pay 30%. That's a progressive tax. A regressive tax is the opposite of a progressive tax. People who make less money are taxed at proportionately higher rate than people who make more money. Under a regressive tax code, someone making $100,000 per year would owe a smaller percentage of their income in taxes than someone making $10,000 a year. Meanwhile, a flat tax, say 10% of income, imposes the same proportional tax on everyone, regardless of their income. In this scenario, higher earners and lower earners pay taxes that are roughly equivalent to one another. A flat tax would mean making filing taxes easy, but perhaps not as fair for all taxpayers. As complicated as doing your taxes can be, there are good reasons for having a progressive tax code. First, it increases government revenue by collecting more than those who can afford to pay more, generating more money for important public services. Second, it eases the burden on lower earners and gives them a greater chance to achieve success. Third, it helps to correct imbalances that occur due to rules that result in dividends and capital gains being taxed at a lower rate than other forms of income. Our progressive tax works by placing earners into different tax brackets according to how much money they make. There are currently 7 official federal tax brackets with rates ranging from 10% to 37%. The dollar amounts that define the brackets change depending on whether you're a single filer, a married joint filer, or qualifying widow or widower, a married separate filer, or a head of household filer. To get an idea of how the tax brackets change based on your filing status, consult with a tax advisor. Determining which tax bracket you fall into isn't as simple as just adding up your total income. Instead, you must calculate your total taxable income, sometimes referred as adjusted gross income or AGI, which is your total income minus adjustment, deductions, and exemptions. U.S. tax filers can choose between subtracting a standard deduction or a list of itemized deductions. The standard deduction is a fixed dollar amount each year, while itemized deductions can include childcare expenses, charitable giving, education expenses, select business costs, mortgage interest, and certain medical expenses, and more. If you're near the lower end of the tax bracket, deductions can not only reduce your taxable income, but send you into a lower tax bracket, significantly reducing the taxes you owe. Once you've determined your taxable income, it's important to understand that not all of the income will be taxed at the same rate, unless you fall into the tax bracket for the lowest earners. Say your taxable income is $75,000. The first $9,950 of this will be taxed at 10%. The rate of the first tax bracket, earnings between $9,951 and $40,525 will be taxed at 12%, the rate of the second tax bracket. Only the remaining $34,475 of earnings will be taxed at 22%, the rate of the third tax bracket. The top tax bracket you fall into is your marginal tax rate. So someone with a taxable income of $75,000 has a marginal tax rate of 22%, even though only $34,475 of that income will be taxed at that rate. Although there are 7 main tax brackets, the percentage of income owed varies even between taxpayers in the same bracket. Here's a pro tip. For most tax issues, your salary isn't important. Focus instead on your adjusted gross income, also called AGI. The views, thoughts, and opinions expressed in the Tax Lady podcast are the speaker's own. The material and information presented here is for general purposes only.